Hi, everyone, and welcome back to Lendy's Financial and Property Update. This month, we're in January 2021. We are officially in the new year. We hope you all had a really great break and are looking forward to a big year ahead. As always, in today's video, we're going to discuss Australia's economic climate and its impact on the property and housing market. In December, we were really lucky to have Alice Stoltz from the Domain Group. She talked us through everything property for 2021. Really informative video, and if you haven't had a chance to watch that yet, I would highly recommend it. But today we thought we would invite back our CEO and co-founder, David Hyman, who is going to talk to us a bit more about property financing in 2021 and what we should be thinking about. So welcome back, Dave.
Thanks, Zara. Great to be back. Great to be here for 2021.
Awesome. Well, let's just jump right in. So, Dave, the current cash rate sits at 0.1%, absolutely historic low. I think there's a little bit of conversation out there at the moment about whether or not they're going to drop the rate again come their decision meeting in February. What are your thoughts on that? And maybe we could take a step back, because I know I'd love to just get a recap on what does the RBA take into account when making those decisions, and therefore do we think we will hit zero this year?
Yeah, I think that's a really good way to think about it. I might even take a step back one layer higher and talk about what the cash rate is and why it's used by the RBA and what sort of purpose it serves. So when the regulators, so whether that's the RBA or one of the other regulators or the government is trying to influence the economy, they've got a few different tools and levers that they can pull to ultimately try and drive economic activity. And those tools broadly fit into two buckets. You've got fiscal policy, which is making laws or changing regulations to ultimately drive economic activity. And we've got some of that happening at the moment. There's a proposed bill to change the responsible lending obligations, which should help free up credit. And that's Treasury driven by government, ultimately trying to drive more economic activity through opening up lending, which is great. And then on the other side, you've got monetary policy. And the main lever in monetary policy is the cash rate. And the way to think about it is, in the most simplistic terms, it's the cost of money as set by the RBA, really in a wholesale sense. And so the cash rate at 0.1% is obviously, as Zara said, as you said, it's historic lows. And what that means is the cost of borrowing for banks and other wholesale lenders is very, very close to zero. And so the cash rate is used as a lever. Either, if the rate goes up, it's used to slow things down if things are getting too overheated, if we're starting to see things like inflation in prices because there's too much activity in the market. The RBA typically targets an inflationary range of 2 to 3%, although there is some new theories around that now being defunct with all this debt that's sitting on all these governments' balance sheets. And on the flip side, if things aren't moving fast enough, and we obviously saw with COVID in 2020, the whole economy ground to a halt across a number of different areas. And the cash rate is one of those areas that the RBA are using to ultimately drive economic activity. And that's why we see it so low. So if we sort of feed all of that into the question, which is, do we think it's going to go up or down? We certainly don't think it's going to go up in the short term. While we saw some positive payroll data earlier in the week, which was really pleasing, actually. The payroll data being data around employment. December was really positive. Actually, December 2020 was better than December 2019, and we're now at pre-crisis levels in terms of payrolls in the market. So that whole cliff that people were talking about happening last year didn't materialize, which is a really positive thing, but we're still not out of the woods. The economy needs to actually overshoot where it was before to repay all this debt that was taken on. There was hundreds of billions of dollars worth of debt taken on by the government, albeit at very, very low rates. And the economy is going to take a number of years it's going to have to recover very strongly and over a number of years in order for us to pay all that debt back. So when we sort of take all of those factors into consideration, we certainly don't think it's going to be going up. And then if we think about it going the other direction, well, it doesn't have a long way to go. We've obviously seen negative rates in other markets. I was just talking to someone the other day about Denmark, who have actually got a 0% mortgage for 20 years for consumers, which is just crazy because they've got negative interest rates over there. I think, and we've spoken about this on previous updates, our opinion, again, we don't necessarily have a crystal ball, but our opinion is that Australia won't go into negative rate territory. There's quite a lot of structural reasons And we won't go into that now, but we don't think it'll go into negative territory. And the amount of leverage or the impact of switching from, say, 0.1 to 0 isn't significant. And while the government doesn't drive the Reserve Bank, the government will use things like fiscal stimulus through things like changing the responsible lending obligations to try and drive more economic activity. So our prediction is that there's a hold in Feb, and we don't see much movement in the short term anyway, neither up or down.
That's really great background. I think it's always good just to remind us of what they think about when they make those decisions. So if we're pretty confident that the cash rate's not going to be moving down, and you've said there a few times, you don't think in the short term it will move up. In the longer term, when it does move up, what should homeowners be thinking about today? So obviously, you buy a home for the rest of your life, and you're lending against that home is often for 25, 30 years. So if you think about that, what should homeowners be thinking about today, given the number of really low fixed rate products out there, but then that variable gives you a little bit more flexibility. So what should homeowners be thinking about to protect themselves?
Yeah, you make a really good point there, Zara, around fixed rates. So we're seeing fixed rates at historic lows without sort of talking to specific lenders, because there is a number of them. There's a number of products in the market that are 1.9 or 1.99% for 1, 2, 3, or 4 years on the fixed rates. And while we don't think there's any short-term risk around rates going up, those rates are actually cheaper than the respective or the comparative variable rates. And so if you've bought an owner-occupied property and you plan to stay in there for 3 or 4 years, we think you should strongly recommend looking at a fixed rate. There's very, very little downside, and there's quite a lot of upside, and certainly upside in just the certainty of knowing that your rate's not going to move around, albeit in small way over the next few years. So we really are at a point in the cycle where that makes sense for a lot of people. If you're an investor or you're looking to move over the next couple of years, and you might want a bit more flexibility, not necessarily because you think rates are going to move, but you might want to sell your property and move to a new one, or sell an investment property as it might be. Variable rates are very, very competitive. They're in the low twos, lowest we've ever seen in the history of the Australian mortgage market.
And as the average Joe punter out there looking to either buy a home or maybe bought a home and is looking to refinance, these 1.9 rates are very, very attractive. But I know some people do get disappointed when they sort of start the process and it's 1.9 is not something they're able to achieve. What kind of advice would you give to people as they start entering this process? And what's a good rate in this market for, maybe it's slightly higher LVR bracket. So let's say it's above 80%. What could and should we be looking at?
Yeah, look, it's a really good point. While those rates are incredibly competitive, they are widely available. So these aren't just very, very sort of high level teaser rates that only 5 or 10% of people can get access to. They are genuinely widely available. But if you fit into one of the buckets that maybe is a slightly higher risk for the bank, and as a result, the interest rate might be slightly higher. So example, and you just made one of those examples, Zara, so a higher loan to value ratio because you've got less equity, or perhaps an investor that might be paying off interest only because it makes sense for their strategy. Rates are sometimes slightly higher. However, we've got to keep it all in the context that we are in a historic low interest rate environment. And so while some people might be getting rates, and we're seeing customers getting rates in the low to mid twos across some of those other segments, those are in some cases 100, 150 basis points or 1 to 1.5% cheaper than where we were this time last year. And so if you haven't looked at refinancing, even if you don't fit into one of those buckets, you are most likely going to be getting a better rate if you move around. So we recommend everyone looks at it, no matter what category you fit into.
That's great advice, as always, Dave. Thank you so much for joining us today and for clearing that up. I know for me, these are always great sessions where I learn a lot and make some decisions on my own home ownership.
No, thanks for having me again, Zara. It was great to chat.
As always, if you haven't checked out our YouTube channel, make sure you go and subscribe using the bell at the bottom of this video. We also have a whole ton of other content on there, including that conversation that I had with Alice Stoltz from the Domain Group back in December. Between her and this conversation, I think you'll have a really great view of what 2021 is going to look like in the property market, both from a housing point of view, but also from a finance point of view. Tune in February for our next update. And as always, if you have any suggestions of topics that you want to see us cover in these, do add them to the comments below. We definitely read them and act on them. So if you have any thoughts or suggestions, add them in there. Thanks so much, everyone. Have a great January, and we'll see you in Feb.